If you haven't heard of an inflationary depression, you better listen to this video because we're going to explain to you not only what it is, but it's likely what we're headed into. So let's dive in.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Okay, Bob. So market pulled back today. Kind of what we've been warning about is starting to unravel here. So while we're in the bearish tone, can you explain to them what this what is an inflationary depression? What's that all about?
Yeah, so in essence, it's inflation running hotter than average and the growth rate lower than average. And, some people call it stagflation, but I prefer an inflationary depression because what they're going to try to do is they're going to try to make it look nominally like the GDP is growing. But what's going to happen is that the ability for people to pay for things are going to slowly open up a gulf between affordability and income. So you're going to start seeing more and more things like break, if you will. And I wanted to kind of illustrate it at the most basic level is even at the lowest level of retail, you got Walmart and you got Home Depot, both complaining and both announcing in their earnings reports that they have to pay more to retain any kind of employment for people. At the same time, their sales are falling below trend. And it's kind of interesting to me because, you and I were talking, I don't know if it was off air or one of our other podcasts, that we kind of got a K economy going here, which means that the upper end is doing great. The lower end is sucking wind. And you see it here at Home Depot and you see it here with Walmart, but it still does not stop Walmart and Home Depot from having to pay more in labor costs because they're really cut to the bone already. And this is like bare minimum that they have to do to basically keep a viable enterprise going. And I just wanted to kind of bring that up. And so we have a precedence for this. This would happen in the 1970s, but a little bit different flavor. In the 1970s, as the boomers were booming, okay, and basically prices got ahead of the ability for the goods to produce enough productivity to keep up with the inflation because of the devaluation they were doing because of the Vietnam War. But yet growing populations, which basically caused the 80s and 90s and 2000 boom. This time we have people actually, more and more people going on fixed income still. And so it's really going to be going from a virtuous cycle outside of this stagflation or inflationary depression into probably something, almost like a nuclear winter kind of approach, because as people retire, they have very limited ability to keep up with costs. And so that's kind of where I was going with this. And this is macro and this is secular. And I think we're gonna be living this for a couple years. And I just want to throw it back to you and get your thought.
No, I think that plays into what we're seeing in the bond market with the yield curve inversion, and typically the bear markets follow when the yield curve inverts, and actually the markets tend to go up as the yield curve inverts, and then only when the yield curve starts to reverse course does the markets tend to go down. But I think we're in a much more weaker state here because the markets topped out as the yield curve was inverting. So as you go in through the yield curve dynamics, we're already much lower than we would typically be in normal market reactions to those things. And I think the bond market never lies. I mean, that's something I really believe in. And so, yeah, I think that the elements are all here for a wage price spiral, and totally agree with you that most people think that we're either out of the woods by 2023 or sooner, or that we're already out of the woods. But I would argue that we're just getting into probably the pain train's leaving the station here. And really, I wouldn't be surprised if we're not out of the woods till Q4 of 2024, which not many people are talking about. But when I look at historical reactions to the bond market, the way things are here, that's exactly the time frame that is potentially in play.
Yeah, it's going to be a nightmare. They already moved up the pivot pause scenario, and Powell might find himself continuing to raise rates here until basically the Treasury Department blows up, with interest rates getting to be intolerable. Right. So it's going to be a really interesting battle going right into an election year too. So guys, if you're invested in companies with a lot of labor, you're probably in big trouble. Okay, especially if that labor is already at what I would call irreducible employment, meaning that if you cut any more employment out of the company, you're basically cutting income at a greater rate than you're taking off your employee expense. And so I think another inflection point has hit, Phil, and I think people need to really, really keep an eye on this, because the next podcast, what we're going to talk about, ties right into Home Depot, but on a different level. Stay tuned for that one, because it's just a continuation of it's a nightmare that you're not going to be able to wake up from for about 2 years.
We'll talk about how to benefit from that too with your investments. All right, guys, thanks for watching. Please hit like and subscribe, and we'll see you on the next one. Take care.
Trade Genius.